As a long-term investor, my favorite investments are well-running businesses that are working in industries with secular trends, have a competitive advantage against their peers, and are undervalued. Unfortunately, it is easier said than done to find such companies. For that reason, I am looking at sectors or countries with a structural undervaluation. In last week's video, I analyzed the general economic and political situation in China in order to see if the current low valuation of China stocks is warranted for or not, and what that means for investors in general. If you're interested in this, I'll put the link to the video in the description below. In my portfolio, I'd still like to have some diversification to Asia in general and to China especially. So today I will try to use my findings from last week to see if I can find some good Chinese companies that are worthwhile to be added to my portfolio as long-term positions. For this, I'll purely focus on the individual risks and chances of each company, as the structural risks are already covered in my last video. The first company I'd like to look at is FinVolution. The FinVolution group operates in the online consumer finance industry, and the company operates a fintech platform that is empowered by proprietary technologies and connects underserved borrowers with financial institutions. So basically, it's a fintech company that mainly provides peer-to-peer credit platforms. FinVolution has the ticker symbol of FINV on the New York Stock Exchange. They are working in the finance sector and were founded in 2007. They have a bit more than 4,000 employees at the moment, and their headquarters sits in Shanghai, China. The market cap sits a bit below $1.5 billion right now. So, as I just mentioned, FinVolution is a service provider for a peer-to-peer credit platform. And basically with their platform, they bring together the borrowers and the institutional funding partners, for example, banks. And in the platform, they provide a bunch of different services. First off, they have the magic mirror model, which is basically a rating model which rates the creditworthy of the borrowers and transmits the data to the funding partners. Then they have the auto-facilitation platform, which finds the best institutional partner for a certain borrower based on their requirements and based also on their credit ratings that their magic mirror model provided for them. They also have a built-in risk management and collection services. So basically they collect the money for their banks from their customers. This is already done with their platform, so the banks don't have to do anything here. And they also have a built-in network fraud detection. So the whole service model basically covers all services that are necessary for the borrowers and for the lenders to come together, and the banks and funding partners can do the whole process over the FinVolution platform. Since their founding in 2007, FinVolution could actually increase their transaction volume by quite a bit. Here we can see the timeline from their foundation in 2007 up to today. And we can see it's a little bit of a cyclical business. We have some ups and downs, but the trend of the overall transaction volume that goes through the FinVolution platform definitely points up. We can also see over the whole time frame, they have a bunch of different milestones here. For example, they were listed on the New York Stock Exchange back in 2017. By 2019, they started their international expansion, and just 2 years ago, in 2002, the international revenue actually made up around 10% of the total revenue. That still means that 90% of their revenue in 2022 came from China. So the focus still is very much on the home market in China. For the time being, their international expansion is limited to Indonesia and the Philippines. But they are also working on expanding to international business. And we can see for this, they are already working on the customer relationship management optimization and also improved customer service. According to their own estimations, their global consumer market size is higher than $40 trillion. If we zoom in a little bit and look at the transaction volumes over the last couple of quarters, split to the Chinese market and the international market, we can still see that the vast majority of their transactions is done in the Chinese market. The international market, however, has been growing quite quickly, especially as a percentage of the total revenue. By end of 2022, the international transaction volumes only made up about 12% of the total transaction volume. And right now it is already making up almost 20%. One of the reasons for this is also that the business in the home market of China has been growing a bit slower over the last couple of quarters. As we just saw, the total transaction volume in China didn't increase so much over the last couple of years, and the same is actually true if we look at the number of borrowers from the Chinese markets. This is shown here in the left-hand side diagram, and here we can see that the numbers didn't increase too much over the last couple of quarters, here from Q1 2021 up until the third quarter of 2023. If we look at the transactional volumes from repeated borrowers, that means from people that have used the FinVolution platform in China at least once over the same period, we can see that the transaction volume of these repeated borrowers has increased quite significantly. That means that people that have used the platform once are quite likely to use it again or even use it for higher volume transactions. So for me, this indicates that FinVolution is definitely doing something right with their customer experience and with their customer handling. We just saw that FinVolution already indicated that they are shifting towards better quality borrowers right now. And here we can see they have a credit rating from 1 to 7, 7 being the worst and 1 being the best. And in this diagram, we can see that borrowers from the class 1, 2, and 3 have increased quite dramatically, especially the borrowers in class number 1. And the borrowers from class number 5, 6, and 7, on the contrary, have declined and only make up the minority of the transaction volume by today. One thing to note is that these classes are based on their own magic mirror rating that is based on their own services. So it is a little bit untransparent of how they do this estimation of the credit rating. And I also cannot say if the credit rating over the whole time frame was actually done the same or if they did change anything in their process. When we look at the general size of the peer-to-peer lending industry in China from 2014 to 2020, we cannot see a smooth uptrend in the market. In contrary, we can see that the market trend fluctuates quite a bit, and the market size in trillion yuan also has fluctuated quite a bit. And in 2017, we actually had a peak and then it came down again. So I cannot see a clear market trend for this industry in China at the moment. When we compare the performance of FinVolution against the S&P 500, and I use the total return here, over the last year we can see that the S&P 500 did outperform FinVolution by around 20%. Over the last 5 years, the situation is actually similar. Here, the S&P 500 had returns of around 100%, while FinVolution only had returns of 30%. But we can also see that within this time frame, FinVolution had actually a time period with very good performance. Only after that, they came down again. When we look at the performance of FinVolution since their listing on the New York Stock Exchange in November 2017, we can see that they actually made negative returns of almost 50%. So over these last couple of years, the stock price didn't seem to improve very much, and they never in the whole time frame reached the valuation they had at their IPO. The trend of their fundamentals, on the other hand, does look quite different. In this graph, we can see the revenue and the free cash flow, and both of these metrics show a clear uptrend. We can see it's fluctuating around a little bit, and the free cash flow also was negative in the past until around 2020. But for the last 3 years at least, we can see a very clear uptrend. The free cash flow has been positive all the time, and the revenue also could increase very nicely over the same time frame. FinVolution also has quite a clear balance sheet. Here we can see that the total liabilities sit at $1.2 billion at the moment, while the EBITDA sits at $920 million. Both are moving in an upwards direction. The EBITDA is even increasing quicker than the total liabilities and the other non-current liabilities. These are the long-term debts. So the balance sheet of FinVolution is not very leveraged. They have a debt to EBITDA ratio of around 1.3. This is very nice to see in the unstable economic environment in China right now. The numbers in their last quarterly update from September 2023 do look a bit concerning though. Here we can see that the revenue did increase very nicely from the first 9 months in 2002 to the first 9 months in 2003, but the operating income did decrease, unfortunately. The main reason for this is that the total operating expenses did increase even quicker than the revenue did. And we can also see this discrepancy when we look at the operating margins and compare 2022 to 2023. So let's sum this up by using my checklist. First of all, the revenue growth over the last 5 years have been sitting at 25%, which easily beats my target of 6%, so green checkbox for me. For the net income growth, it is actually the same. The CAGR of the last 5 years have been sitting at almost 15%. Unfortunately, over the last year it came down a little bit, and over the last year it didn't grow very much. But still, 15% CAGR over 5 years beats my requirement of 10%. So green checkbox again. We could see some free cash flow growth over the last couple of years, but I cannot put a number here because 5 years ago the free cash flow of FinVolution was still negative. And I also put a yellow checkbox here, even though we did see some growth, because I still would like to see at least 5 years of free cash flow growth in order to be sure that the company can also keep growing their free cash flow and doesn't drop back to the negative values anytime soon. The balance sheet of FinVolution was very clean. We only saw a debt to EBITDA ratio of 1.3. This is very nice to see, and these are exactly the companies that I'm looking for in the current Chinese economic environment. Even though FinVolution is a very young company, they are already paying dividend, and the dividend yield sits at a very nice 4%. The margins and return of invested capital, as we just saw, did decrease over the last year, so it's a yellow checkbox for me, but overall FinVolution doesn't look too bad to me. Before we sum this up, let's head over to Seeking Alpha to check the valuation of FinVolution. And what we can see here is that the valuation against the sector median is actually very, very low. Here we have the trailing 12 months PE ratio, and we can see it's not even half of the sector median. Same is true for the EV to EBITDA, and actually the same is true also for the price to cash flow ratio. Although the price to cash flow ratio is lower than the sector median, but not as far as the other valuations. But still, the overall valuation of FinVolution looks to be very cheap. As a dividend payer, I also like to look at the dividend yield of FinVolution, and here we see that the average dividend yield has been sitting at very similar levels, at least over the last couple of years. It was also always around these 4 to a bit higher than 5%. So from a dividend yield perspective, their valuation right now seems to be around average of the last couple of years. The analyst ratings of FinVolution seem to prove the low valuation also. Here we can see that even the minimum scenario of the analyst forecasts still points upwards of around 1.5%, and the maximum even forecasts an increase of almost 40%. The earnings per share are also forecast to go up, same as the revenue over the next couple of years. FinVolution can show some impressive growth results over the last years with very strong 5-year growth rates. Last year, the company did struggle a bit to keep growing with similar rates as the years before, mainly due to the weaker performance in their home market of China. But their expansion strategy to Indonesia and Philippines is already showing some success. That leaves FinVolution in a very good position to keep expanding the market share in the region. It is also worth noting that the company is already the 3rd largest player in Indonesia's peer-to-peer loan market, with a market share of around 6% recently. But the company itself stated that they expect a consolidation in the fintech and peer-to-peer market to happen soon, and the latest regulatory developments might increase the entry barriers for this industry. As one of the bigger and high-quality players in this region and market, these developments might even benefit FinVolution though, and I would expect that their operations in China also improve over the next couple of years, and with their operations also their margins again. The low level of debt and clean balance sheet also gives them some room to operate and limits the risks from higher interest rates. And the company even started paying dividends back in 2019, and the current dividend yield looks quite juicy for a growth company. What I don't like so much about the company is the competitive environment and the strong and changing regulations in this fintech and peer-to-peer sector, especially in Southeast Asia. I am also not so certain about how the general peer-to-peer market in China will develop over the next years, as in the last years the market trend was a bit bumpy and didn't show a clear uptrend. The next company is JD.com. JD is a provider of supply chain-based technologies and services in China. They offer computers, communication and consumer electronic products, as well as home appliances, food and beverages, and in generally a very wide portfolio of different products in offline retail stores as well as online. It also provides online marketplace services for third-party merchants, marketing services and omni-channel solutions to customers and offline retailers, as well as online healthcare services. In addition, the company develops, owns and manages its logistics facilities and other real estate properties. The ticker symbol is JD and they are listed on the Nasdaq stock exchange. They are working in the consumer sector and were founded in 2006. They have around 450,000 employees at the moment and the headquarters sits in Beijing, China. Their market cap sits at $36 billion at the moment. The company reports 4 segments: JD Retail, JD Logistics, Dada, and New Businesses. JD Retail, including JD Health and JD Industrial, among other components, mainly engages in online retail and online marketplace services in China. JD Logistics includes both international and external logistics businesses, and Dada is the local on-demand delivery and retail platform in China. New Businesses includes JD Property, Jinxi, and the overseas businesses. From the revenue share alone, we can already see that JD Retail is by far the biggest segment of JD.com. And all of these segments, except the new business segment, have been growing on a year-to-year basis from the third quarter 2022 to the third quarter of 2023. In its home market of China, JD operates a network of nationwide warehouses and they cover almost all countries and districts in China. They have more than 1,600 warehouses there, working more than 300,000 delivery people. So these numbers alone show that JD is a powerhouse when it comes to retail logistics in China. But they don't stop there. In January of 2022, they launched their Okema services in the Netherlands and in Europe, and with this they provide an online and offline shopping experience to European customers. So they basically try to provide the services and products they also offer in China to a more international customer base. And with this expansion, Okema's home delivery service was expanded to 24 new European countries. But not only are they trying to bring the services and products they offer in China to a European audience, they also do it vice versa. Here, for example, JD Worldwide just opened a fashion warehouse close to Paris to streamline the cross-border e-commerce for European brands into China. That means that this warehouse is exclusively dedicated to house fashion merchandise from France, Germany, UK, Italy, Spain, and other European countries and import them to China. Currently, they host a selection of 100 respected brands in this warehouse. And with this approach, they hope to meaningfully reduce the fulfillment costs for local sellers and also provide a faster delivery to their customers. What I also find very interesting is that JD is providing these autonomous driving delivery vehicles, and they not only do this for driving delivery robots, they also do it for flying delivery drones. So the company is trying to take the significant advantage that they already have from their massive e-commerce scale to also operate a self-driving logistics network. With the development and deployment of these autonomous vehicles on a large scale, they hope to accumulate enough data to adequately train AI to basically further improve the function of these drones and of these self-operating logistics networks. And if you remember the second business segment of JD.com, they also provide their logistics services to third-party merchants. Over the last couple of years, JD could show a solid growth of their net revenues. So between 2017 and 2022, they show a revenue CAGR of 24%. When we break this down, we can see that most of this revenue actually comes from product revenue, so from sold products. And only a very small portion comes from their service offerings. When we compare the last quarter of 2023 to the last quarter of 2022, we can see unfortunately that the product revenue went down a little bit, and here we had a year-over-year growth of -1%. The service revenues, on the other hand, did grow quite nicely, with a year-over-year growth of 13%. Overall, it seems that the operating income over the last quarters has been fluctuating quite a bit. And if we also look at the operating margins above here, first of all, we can see that the margins are very small. This is basically expected for a retailer. The second thing is that the margins also have fluctuated quite a bit over the last couple of quarters. The net profits, on the other hand, show very nice stable uptrend. Here we can also see the cyclical nature of JD's business. We have some years where the net profit went down a little bit, 2018 and 2021, for example. Although in 2021 it didn't go down, it just didn't increase so much. But also the net margins are on a very, very low level, although it seems to be increasing, especially in the recent quarters. When we compare the performance of JD.com to the S&P 500, over the last year we can see there's quite a bit of underperformance of JD compared to the S&P. Where the S&P 500 delivered almost 13% returns, JD.com delivered -53% returns. Over the last 5 years, it actually looks quite similar. Here we had a total return of the S&P 500 of around 100%, while JD.com only had returns of -25%. And even when we look over the last 10 years, JD.com only delivered returns of 13%. But we can also see that over a long period of time, JD.com actually did outperform the S&P 500, and only since the beginning of 2023, they lost ground against the S&P 500 again. Similar as FinVolution, the fundamentals paint a very different picture here. And if we look at the 10-year growth trend of the revenue and the free cash flow, we can see that we actually have a very nice growth over the whole time frame here. The free cash flow is fluctuating around a little bit from quarter to quarter, but in general we can see a very nice uptrend. Since 2022, the revenue and the free cash flow has stagnated a little bit, and we can see it went flat above here. But again, this can be explained with the general economic weakness of China. When we look at the long-term debt and the EBITDA, we can see that first of all the EBITDA in the purple line here did also increase very nicely over the time frame, but over the same time frame they also increased their long-term debt a little bit. Still, the EBITDA at the moment is higher than the long-term debt, so we have a very clean balance sheet, and JD.com doesn't seem to be too leveraged at the moment. JD.com is a dividend payer. They pay a current dividend yield of 2.7%, and they have a very small payout ratio of only 20%. They only started this dividend very recently, so we don't have any dividend growth here and also no 5-year growth rate. But with the current fundamentals and the very low payout ratio, I think that there is still quite some room for them to grow these dividends. So when we sum this up by using my checklist, first of all, we can see that JD.com beat my revenue target of 6% easily with a 20% 5-year CAGR. Green checkbox for me. The net income grows. They also beat my target of 10% on the 5-year CAGR easily with 76%. Again, green checkbox. They have a very nice free cash flow growth, 22% on a 5-year CAGR and almost 90% on a year-over-year basis. So very nice to see, green checkbox for me. The balance sheet, as we just saw, is very clean. Their debt to EBITDA ratio sits at around 1. So also very nice to see and very important in the current economic environment of China. JD.com is a dividend payer and they pay a dividend of 2.7% at the moment. We cannot say the 5-year CAGR right now because they just recently started paying the dividend. So this is something that needs to be seen in the future. What we also just saw is that they could increase their margins and the return of invested capital very nicely, at least over the last couple of years, although it's also fluctuating on a quarter-to-quarter basis a little bit. Still, the general trend is pointing upwards, so green checkbox for me. So overall, with 6 green checkboxes, JD.com does seem like a very good candidate for our long-term portfolio. Before we come to our conclusion for JD.com, let's also have a look at their valuation. And the PE ratio of JD.com sits at around 10, which is around 40% lower compared to the sector median. And the forward PE ratio sits at 9, again, around half of the sector median. But also, if we look at the JD.com 5-year average of the forward PE ratio, it was sitting at 85. So this is a decline of almost 90% of the current valuation compared to their 5-year average valuation. Same is actually true if we look at the cash flow, again around half of the sector median, and EV to EBITDA only a third of the sector median, and also around 90% lower compared to their 5-year average. So at the moment, JD.com really seems to be valued very cheaply. And the analysts actually seem to confirm this very low valuation. Based on 35 analysts, the minimum rating still has an upside of around 7%, and the maximum rating of these analysts almost 300% upside. The forecast for the next couple of years for the earnings per share is also pointing upwards quite nicely, and the same is actually true for their revenue. So JD's strong position not only in the e-commerce but also in the logistics and delivery market makes them a very resilient player in the current cycle of China's economy. The current lower growth rates due to the weak overall economy are once more proof how affected these consumer businesses are by general economic downturns. But I would expect that their growth to pick up speed again as soon as the economy picks up again. Still, the company can show good growth in the top line as well as in the bottom line over the last 5 years, while managing to keep a very clean balance sheet without much debt. With their Okama platform, they are trying to expand to Europe at the moment, which presents a vast opportunity not only for further growth, but also for a better global diversification of their revenues. I also like their focus on efficient logistics and good customer experience. The current cheap valuation does give some margin for error, but as a consumer-focused business, the company could also be hit hard in case the Chinese economy has a further downturn. I still do like the company as an investment, and a dividend yield of almost 3% makes the investment even more attractive for me. The cherry on top is the very low payout ratio of under 20%, which leaves a lot of room for potential future dividend growth. Last but not least, let's have a look at JinkoSolar. JinkoSolar Holding, together with its subsidiaries, engages in the design, development, production and marketing of photovoltaic products. The company offers solar modules, silicon wafers, solar cells, recovered silicon materials and even silicon ingots. It also provides solar system integration services and develops commercial solar power projects. The company sells its products to distributors, project developers, system integrators and manufacturer of solar power products under the JinkoSolar brand. Their ticker symbol is JKS on the New York Stock Exchange, and they are working in the technology semiconductor services sector. They were founded in 2006 and have around 46,000 employees at the moment. Their headquarters sits in Shangrao, China, and their market cap at $1.4 billion at the moment. It is no secret that the energy consumption worldwide is increasing very significantly, and with the power consumption also the power production from renewable energy sources. The biggest consumer of energy worldwide is actually China by quite some margin. If we look at the types of different power generations in China right now and the forecast in the future, we can actually see in this light orange area that the power generation from solar plants is bound to increase most out of all of these energy types. So we definitely have a secular trend here, not only for renewable energy in general, but specifically for solar power and specifically in China. So who else should benefit from this trend if not the Chinese solar module manufacturers like JinkoSolar? When we look at the business mix and the regions that JinkoSolar is operating in, we can see that around 40% of their revenue are coming from China, but they are also shipping to many other regions in the world. A good part of their revenue comes from Europe, from North America, APAC, and also emerging markets. So they have quite a nice diversification over the whole world. And when we look at the products they actually sell, we can also see that 60% of their sold modules in the last quarter of 2023 came from N-type modules. Compared to P-type modules, N-type solar panels have a higher conversion efficiency and a longer lifespan. But they are also more expensive and not everybody can produce them, so they are not as widely available. In the worldwide market share of different solar panel types, the N-type panels, here marked in orange, only make up around, at the moment, 15% of the whole market share. But we can also see that over the next 5 years, this should be around doubled to 30%. And with the higher price and with not so many manufacturers being able to produce these N-type solar panels, JinkoSolar will definitely be one of the benefactors of this trend. JinkoSolar is actually not only selling to a worldwide customer base, but they are also producing worldwide. Here, marked in orange, we can actually see the overseas manufacturing facilities in Vietnam, Malaysia, and the US. And over the last couple of years, they could increase their overseas sales and manufacturing capability by quite some bit. Again, what is very nice to see here is that the N-type cells, marked in light green, make up the vast majority of their solar cells types. When we dig a bit deeper in the latest annual report, we see that solar modules actually make up the vast majority of JinkoSolar sales. In these solar modules, they actually only started selling the N-type modules in 2022, but in 2022 it already made up around 1/4 of the overall sales in this period. Smaller portions of the sales also includes the sales of silicon wafers and solar cells. In the last quarterly update, JinkoSolar shows the growth trend over the last couple of quarters from Q3 2022 to Q3 2023. And here we can see a steady increase over all of these metrics. We can see revenue and total shipments went up in generally over the last quarters. Gross profit and also gross margin went up over the last couple of quarters. Gross margin even by 4%, which is very nice to see. The net income and the net margin also went up from very low values of the net margin to around 4% right now. And the same is true for the GAAP net income numbers and net margins. Here we can also see a general very nice uptrend over the last quarters. When we compare the performance of JinkoSolar against the S&P 500 again, in the last year they did underperform the S&P 500 by almost 80%. Over the last 5 years the trend looks a little bit better, but again here the S&P 500 had returns of around 100%, while JinkoSolar had returns of 50%. So they only made around half the returns compared to the S&P 500. Over the last 10 years, the trend looks even worse, unfortunately. Here we have a performance of the S&P 500 of 230% compared to minus 10% of JinkoSolar. So investors in JinkoSolar definitely had not a good time over the last 10 years. When we look at the revenue and the free cash flow, we see the same trend for the revenue actually, but unfortunately quite a different trend for the free cash flow and the cash flow from operations. Here, first of all, we see that the free cash flow has been negative over the whole time frame of the last 10 years, but also the cash flow from operations has been fluctuating around the $0 mark for quite a while, but recently, since 2022, the cash flow from operation declined significantly and is sitting at minus $900 million almost. So it seems that JinkoSolar cannot translate their top line growth to bottom line growth also. Here the EBITDA was also fluctuating for a long time around the same values, but since the end of 2022 it went up quite significantly. Unfortunately, over the same time frame, the total liabilities of JinkoSolar also increased quite a bit. And even if we exclude the current liabilities and only look at the long-term liabilities to EBITDA, the ratio still doesn't look so good. When we sum this up with my checklist again, we can see that the revenue growth, first of all, was very nice over the last 5 years, 37%, definitely a green checkbox for me. The net income also did grow with almost 70% over the last 5 years and even 2000% increase on the year-over-year value. Very nice to see, definitely a green checkbox for me. Unfortunately, this is where the problem starts. The free cash flow is currently negative and we cannot see any growth here, so this is a very red checkbox for me. And also the long-term debt to EBITDA ratio sits at 5 times long-term debt to EBITDA, which is quite a bit above my target of 3 times. And especially for a Chinese company in the current economic environment, this is a definite no-go for me. Even though they have a negative free cash flow, JinkoSolar started paying a dividend a couple of years ago, and they pay a dividend with a huge payout yield of 5.5% right now. Over the last couple of years, we could see that they could increase their margin and the return of invested capital, so in this case, it's definitely a green checkbox for me. Before I come to my conclusion, let's also have a look at the valuation grade at Seeking Alpha. And here, the PE ratio sits at around 1/10 of the sector median. We can see PE ratio of JinkoSolar of 1.6 compared to a sector median of around 30. The same is actually true for the EV to EBITDA. Here again, we can see JinkoSolar has a multiple of around 6, while the sector median sits at 17, almost 18. Of course, we cannot look at the price to cash flow ratio of JinkoSolar as they have a negative cash flow. In general, they do seem to be very, very cheaply valued, which is actually no surprise with the massive negative free cash flows that they have at the moment. The analyst ratings also reflect a higher uncertainty with JinkoSolar compared to the other Chinese companies that we saw before. Here, based on 9 analyst ratings, we can see that the minimum rating sits at actually $11.6, which is a decline of more than 50% from the current stock price, while the highest analyst rating sits at $50, which is an increase of around 90%. The EPS and revenue forecast for the next couple of years actually looks quite nice. Even though the EPS is expected to fluctuate a little bit, the general trend seems to be pointing upwards. And the same is actually true when we look at the revenues. Here again, we can see that it should fluctuate a little bit in the next years, but in generally, the forecast is pointing upwards. Despite the incredible top-line growth, increase in market share and positive outlook for solar energy in China, investors in Jinko didn't see big returns over the last 10 years. The stock is still held back by weak cash flow management and weak operating cash flow. Even though this is understandable as the company is trying to expand its business, the current state of the market and China's economy make this a very dangerous strategy. It also doesn't help that the long-term debt has increased while the management decided at the same time to pay a dividend financed with debt. The technical capabilities, on the other hand, are quite impressive, with the more expensive and higher priced N-type solar modules already making up more than 60% of their revenues. I also like the global diversification, not only of the customers, but also of the manufacturing plants. But this also leaves them quite vulnerable against geopolitical risks. Because of the lack in cash flow and the high debt, I'd still wait a bit to see how the management will proceed with this. Please note that Jinko will report their latest annual earnings for 2023 on Friday, 8th of March, which is actually after the recording of this video, so I didn't take these numbers into account for my analysis yet. I still do find Jinko very interesting and I will put them on my watch list, but before investing, I will wait a bit and see if they can improve at least the cash flows and if possible also their balance sheet. With the current numbers and the current uncertain environment in China, the company is just too risky for me. So if you didn't guess it already either way, from the 3 companies analyzed today, I do like JD.com most from the perspective of a long-term investor. The other two companies also have their merits, but the stable running business of JD, coupled with their expansion plans to Europe and their focus on logistics, makes them a very appealing business to me. The balance sheet also looks rock solid and gives them some operating room in the uncertain economic environment right now. Today's video was a bit different than my regular format. If you do like this type of content and if you would like me to do this more often, please let me know down in the comment section. Also, I'd be very interested in what you think. Which of the three companies do you like most, and what risks and what chances do you see? With that being said, if you did like today's video, please smash the like button and consider subscribing to the channel in order not to miss my next analysis. Other than that, thank you very much for watching and see you next week.